Welcome to this week's episode of Jonathan on Money. This is episode number 128. So last week was Rosh Hashanah for Jews around the world, a time of prayer, repentance, family, and introspection. While each of these themes holds deep significance, I find that introspection is especially foundational in setting the stage for a successful future. This applies to all facets of life, including one's finances. As I reflect on the new Jewish year, 5786, I just want to share some thoughts as we begin the new year. I've come to appreciate that no matter the headlines, every year, good or bad, there are several timeless investment principles every investor should understand. Familiarity with these concepts can help position us for a year of financial clarity and success. And principle number one is the unpredictability of the markets. As recent financial headlines show, the market can plummet one day following the announcement of tariffs and then skyrocket the next. International stocks, which have underperformed for years, are currently up double digits as of this recording. The takeaway is that nobody, not even seasoned Wall Street strategists, can reliably predict what will happen year to year, and that's okay. If we could foresee the future, investing would be far simpler. The key to navigating this unpredictability is to avoiding the trap of putting all your eggs in one basket. This strategy is known as diversification, which I bring up all the time. By spreading your investments across a range of asset classes and geographies, you reduce concentration risk and position yourself to weather whatever storm may come. Principle number two is don't time the market. Given the constant fluctuations in stock prices, it's always tempting for investors to try to time their entry and exit or to chase the latest hot investment. But this strategy simply does not work. Putnam Investments published a compelling study a few years ago illustrating the pitfalls of market timing. They analyzed the 15-year periods from December 31st, 2006, December 31st, 2021, and found that staying fully invested in the broad market would have yielded a 10.66 annualized return. Missing the 10 best days would have dropped that return to 5.05%, missing the 20 best days to 1.59% annualized, missing the 30 best days, a negative 1.18%, and missing the best 40 days would have annualized a more than negative 3.5%. The takeaway is clear. Jumping in and out of the market puts you at serious risk of missing the best performing days, which are often clustered around periods of volatility. For example, if investors panicked in April of this year after the tariff announcements and exited prematurely, they would have missed the entire market rebound that followed. Principle number three is to stay optimistic. Positive thinking is one of the defining traits that has sustained the Jewish people for over 5,000 years. This is something I reflect on during the holiday of Rosh Hashanah. Optimism is also a core characteristic of many successful investors. Maintaining a bullish outlook on the long-term direction of the markets often leads to favorable outcomes. Pessimists may dominate airtime on financial news networks, but they're frequently wrong. A prime example of this is after the great financial crisis of 2008-2009. Many of the strategists who predicted that downturn have continued forecasting the next recession or bear market. Meanwhile, the market has gone on to deliver one of the longest and strongest bull markets in history. Stay positive and position your portfolio with optimism. Over time, the market tends to reward those who believe in its resilience. Principle number four is to ignore the noise. There are countless distractions out there, talking heads, financial influencers, friends, and your broke brother-in-law. Most of what people say or what's happening around the world is not directly relevant to your portfolio. Yes, it can be unsettling to hear about geopolitical tensions, war, or negative economic news, but it's critical that investors avoid making financial decisions based on headlines or herd mentality. Instead, focus on what truly impacts your financial life, your time horizon, risk tolerance, family dynamics, and specific goals. Most other information is just noise. And principle number five is a framework for making the right decisions. Establishing a clear framework in the new year for financial decision making can be immensely beneficial. Key principles include spending within your means, maintaining a healthy savings rate, investing prudently, and avoiding emotional reactions. Good financial choices require discipline. That's why automating as much of the investment process as possible can be a game changer. For example, setting up your accounts to automatically deposit a portion of each paycheck directly into predetermined investment can help keep you on track and reduce the temptation to deviate from your plan. Principle number six is to stay the course. One of the greatest determinants of financial success is the ability to stick with a strategy across varying market environments. Success in investing, and in most areas of life, comes down to consistency. Legendary quarterback Tom Brady once said, and I love this, to be successful at anything, the truth is you don't have to be special. You just have to be what most people aren't: consistent, determined, and willing to work for it. There are no shortcuts. If you have a sensible plan in the new year and stay the course over time, you'll be amazed at the wealth you can accumulate. And here's just one final thought. Regardless of the challenges or opportunities you face this year, it's important to remember that nothing lasts forever. Life and the markets are cyclical. If the year 5785 was a difficult year for you, it won't stay that way forever. And if 5785 was a banner year, that too will eventually change. This constant ebb and flow is part of life's rhythm. It offers hope when things don't go our way and reminds us to stay humble when they do. The key to a successful financial future lies in appreciating these ups and downs and having a plan in place to navigate them with clarity and resilience. Embracing these six aforementioned principles in the coming years will help prepare you for a financially successful year ahead. Shifting gears just a bit, my upcoming fall live webinars will continue on October 16th at 8:30 a.m. on structuring buy-sell agreements right, what advisors and owners need to know, featuring Jack Elder, head of CBS Advanced Sales and Comprehensive Brokerage Services, and I'll be sure to include the registration information in the show notes to this episode. Okay, now for today's agenda, and then my opening was a little longer this time, but I did have that on my mind with Rosh Hashanah. But my agenda for this week and the talking points are going to be a question I received on contributing to multiple retirement accounts at work, which is more exciting than it sounds, I promise. Our quote this week is about positivity from Albert Einstein. I'll spend the last half of the episode answering listener questions, including forecasting one's tax liability in retirement. And finally, we're going to end with an actionable idea to implement your investing life, where we'll discuss how to have an impact with your portfolio by investing in regions of the world that promote democracy and Western values. With that, let's jump into this week's talking points. So I received the following question recently, and it said, I'm employed by multiple employers. How much can I contribute to all my retirement accounts? So I deal with retirement plans, individual retirement accounts, and retirement planning every day. People are always surprised at how complicated and convoluted the planning can be. Similarly, with this question, which seems straightforward, there are actually a lot of factors that depend on it. Unfortunately, the answer is far more technical than you might imagine. Okay, so let's just dig into it. So, without knowing the specifics of your employment situation, I'll give you a brief overview. If you have multiple employer sponsored retirement accounts, such as two 401ks or a combination of 401k and a simple IRA, your individual contributions across all plans cannot exceed the annual IRS limit of $23,500 for 2025. However, employer contributions are separate and can be made to each plan independently, meaning you could receive employer contributions in multiple plans up to the total defined contribution plan limit of $70,000. For example, if you work two jobs and both offer a 401k, you can split your $23,500 contribution between them however you choose. If you also have a solo 401k for self-employment income, you can contribute as an employee up to the same $23,500 limit, but employer contributions, like a profit-sharing plan, can be made separately, increasing your total savings potential. Now, if you have multiple employers that are unrelated institutions, the employer can contribute up to the defined contribution plan limit of $70,000 per plan. This means that if you work for two separate companies, each could potentially contribute up to $70,000 into their respective retirement plans, allowing for a much higher total employer contribution across multiple plans. However, if the employers are related, such as subsidiaries of the same company or under the same ownership, the total employer contributions must be aggregated and subject to a single $70,000 limit. And I do hope that's helpful. As I always say, the corporate retirement area is overly complex. Sadly, that's the world we live in. Complicated. Okay, those are the talking points this week. And as a reminder, you can be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Albert Einstein. For those who don't know, Albert Einstein was a German-born theoretical physicist who's renowned for developing the theory of relativity, which revolutionized modern physics. His equation, E equals mc squared, became iconic. He was a proud Jew. Einstein was deeply influenced by his heritage and spoke out against anti-Semitism and fascism. He fled Nazi Germany in 1933 and settled in the U.S., where he supported the Zionist movement and helped found the Hebrew University of Jerusalem. Einstein received the Nobel Prize in Physics in 1921 and remains a symbol of intellectual brilliance and humanitarian commitment. Interestingly, Einstein was officially offered the presidency of Israel on November 17, 1952. Following the death of the country's first president, Chaim Weizmann, the offer came from Israeli diplomat Abba Eban, who assured Einstein that he would have a full freedom to continue his scientific work if he accepted the largely ceremonial role. Einstein did decline the offer, citing his lack of experience with people and governance. And what Einstein said once was stay away from negative people. They have a problem for every solution. The quote points out that negative people tend to reject optimism, progress, or helpful ideas, often finding flaws or obstacles even when solutions are offered. While negative people are a drain on your energy and not helpful in life, this is doubly true in the world of investing. Remember, bad news sells, and that's why so many perma-bears, which is a nice way of saying market strategists who are constantly negative on the economy or markets, tend to get lots of airtime on the financial news networks. People listen when they say the world is coming to an end. However, the reality is they are always wrong in the end. The markets go up over time. This is something that has been true throughout market history. So do yourself a favor and ignore and avoid negative people and surround yourself with people who are positive and have a can-do attitude. Your life and portfolio will be better off for it. Okay, now let's jump into this week's financial questions. If you do have a question, feel free to submit it to me and it may be answered in a future episode. And I have a bit of a backlog of questions, so I actually will do a few more today than usual. So there will be a bonus round. First question. Any takeaways on Warren Buffett's retirement announcement this year? Yeah, being able to work until age 95 and enjoying what you do is pretty geschmack. Being able to do so while you drink 3 cans of regular Coke and eat McDonald's every day is even better. Unfortunately, most people can't work that long, especially if their diet is primarily fried food and soda, and don't have fun at their job. The key takeaway is this: Warren Buffett is not like most of us, and that's okay. When it comes to his longevity, mental acuity, and financial success, he's an outlier. You likely won't be able to work as long. You won't have a career in something you're super passionate about. You won't be a billionaire. You certainly won't have 20% annualized compounded returns for 6 decades. And 50,000 people aren't going to come hear you speak every year until you're age 94 or ever for that matter. All those things are fine. In fact, it's normal. The big takeaway is not to compare yourself to an outlier. I hate to break it to you, but you will never be like Warren Buffett. You won't have his success, and hopefully you won't experience his sorrows either. You will live a life comparably normal life. But if you live within your means, spend your time and money on things that are important, and pass down the right values for the next generation, you will be a success. Next question. How can I forecast my tax liability in retirement? You can't. There are too many variables that will change. This includes where you live, your income, future tax rates, your marital status, future deductions, and so forth. People in my industry like to nerd out over these types of long-term projections, but the truth is, in the long term, all the inputs in this type of analysis are up in the air. Using a Roth IRA may allow for some certainty since you don't pay tax when you take out the money. Additionally, if you save enough money, you will have a large cash nest egg where the taxes will matter less. Finally, trying to predict future tax rates should not be the main driver of your decisions in life. The CPAs listening to this may find this line triggering, but this is the truth. Instead, focus on big picture items. Saving enough, investing properly, focusing on important things in life. Getting caught up in the details is generally not the best idea as it will hinder your progress. Next question. I was zinged with a huge tax bill this year. My CPA said I can lower it a bit next year by maxing out my profit sharing plan. The issue is I max out my profit sharing plan. The issue is if I max out my profit sharing plan, I can't save as much to put down a down payment on a vacation home, which my wife and I really want to do. Should I max out my profit sharing plan like my CPA advised or save more money for that down payment? So it sounds like you save enough for retirement already. If this is not the case, then you should do that first. However, once you're saving enough, you should spend your money. You don't get a medal at retirement for saving the most you possibly can at the expense of everything else. Prepare for your future and then use the rest of your funds to enjoy life. In your case, that seems to mean that you should buy that vacation home once you have the cash available. Ironically, diligent savers have the hardest time spending their funds, even if they can afford to do so. Where many spenders who never save enough money have zero issues with spending their money, even though they cannot afford to do so. Buy the apartment, pay the taxes, and live life to the fullest. Next question. I have spread my investments across 7 different real estate syndications, 3 private credit deals, and 4 private equity funds. Is there anything you would recommend to my existing portfolio to keep it more diversified without sacrificing return? Your portfolio is dreck. Whoever recommended it to you needs a firm patch on their tuchus. Your investments are unnecessarily expensive, tax inefficient, illiquid, highly levered, and not adequately diversified. Total and complete dreck. The only good news is due to these investments' illiquidity, you can pretend that you're making a lot of money until reality sets in. However, ultimately, you will come to the same conclusion that many experienced investors arrive at, which is this: you are overcomplicating your life, underperforming the market, taking more risk, and paying more in taxes. I would recommend liquidating these investments as soon as you can and diversifying among stocks, bonds, and cash. I would move this cash to one financial institution. Your life and ability to grow your wealth will improve. This may be a hard pill to swallow, but the sooner you see things my way, the better off you'll be. Next question. Why don't you do hourly consulting work? I actually get a fair amount of requests for hourly work. The reality is it doesn't make a lot of sense. It's cumbersome. It's not lucrative, and the people that tend to want that service are massive pains in the tush. They sort of want to do it themselves, but don't have the knowledge, time, or ability, so they ask a lot of questions, fight with you on every answer, get caught up on every penny they're paying, and usually don't implement the advice you give them. They also won't do as well as folks that who pay in assets under management model, where there is less friction. The goal of my life at this point is to interact less with pain in the tush people. It's not to attract more of them. Bekitzer, it's not a rewarding business model, financial or otherwise. The best way to build a business is to find clients who want your advice, allow you to implement it, and are happy to pay for that service through an assets under management model that is seamless and aligned in the interest of all parties. The clients are being taken care of, and as they make more money, so do I. Next question. My wife and I went to visit my brother in a community in a suburb of New York City. The houses are gigantic. There are some normal sized houses too, but how do people afford their massive mansions while sending their kids to yeshiva and $30,000 plus in property taxes every year? So I've received a version of this question before, but it was around 3 years ago, so it's worth repeating. There are many possibilities with the large houses and big expenses conundrum. The reality is some people have a lot of money, which allows them to buy or build a large house. Others have a high income and can technically afford to build a massive house. Some people worked for years and lived below their means, so they have a lot of money saved. Others borrowed a lot of money and can handle the debt service. Some folks overextended themselves and borrowed too much money and now ruin themselves financially just to keep up with their friends. Some people have parents or in-laws that gave them money. Perhaps some of these large houses were purchased many years ago before the housing market in that area skyrocketed in value. Maybe some of these people stood up the contractor and got a discount. The point is, you shouldn't worry or spend a lot of time thinking about it. You shouldn't think about what others are doing. Run your own race, which is something I constantly try to remind my clients. The one thing that is important to keep in mind when you see people with large houses and luxury goods is this: wealth is what you keep, it is not what you spend. All the fancy items you see around town show you how much money was spent, and it's not actual wealth. Next question. Vanguard has a financial advisor program. It's super cheap. Why not use that instead of going to a financial advisor elsewhere? So the Vanguard financial advisors are glorified product pushers. They're not financial advisors. When the only solution a financial advisor can provide are products or strategies managed by their employer, you're not in the financial advice business. You are in the selling of my firm's products business. To pay a fee just to have someone sell you a predetermined set of products is absurd. I would steer clear of these types of programs and instead hire someone who does not have this same type of conflict of interest. Next question. I have the opportunity to invest $360 in Tali Cubby at my shul for convenience, or I can die $360 in today's dollars richer. What do I do? Let's work the math. Let's assume you'll live in this community for another 30 years. Now let's assume an 8% annualized rate of return, which is pretty generous but helpful for this scenario. So $360 growing for 30 years at 8% annually is approximately $3,600. A nice chunk of change, but in no way impactful to your life. So the opportunity cost of giving $3,600 is a pretty sweet deal for 30 years of cubby space. Even if you don't need the cubby for your tallis, you can still use it for other purposes like storing water, snacks, lollipops, cough drops, herring, and a flask for your kiddish club. Tums to minimize heartburn after the kiddish club, reading material in case you get bored during services and there is no one to talk to, etc. I'd move forward with the cubby rental unless your shul changes the rules on you and says you need to pay more money on an ongoing basis. That's BS, and you shouldn't make a deal with anyone who changes the parameters of the deal after an agreement is reached. Just my 2 cents. Next question. What's the best way to save for my kid's wedding? Assuming I'll need 150K for my portion of the chasana, how do you go about doing that? Whoa, hold up there, bro. Your first mistake is assuming that a wedding needs to be that expensive. 3 words for you. Takana Hall Baby. Planning to spend $150,000 on a wedding is the wrong approach. Next, if you say, to heck with you, Shenkman, I want to spend $150,000 on a 5-hour event that no one will remember after they walk out of the wedding hall, then you need to start planning early and follow this framework. One, start early. When a child is born, you should open an account in your name so that you control the money. You should then immediately start funding it. The longer you wait, the shorter your investment dollars will grow. Time is your biggest asset, and you should make sure not to waste it. Number two is to automate your savings. If you need to manually deposit money into your account, you will never stick with the strategy. It will be too hard as other life expenses get in the way, or you get nervous from the market gyrations. Instead, pick up a dollar amount to contribute monthly and have it deposited and invested automatically. It doesn't have to be a vast sum of money. Over a multi-decade time horizon, even a modest amount of money can add up. Three, invest aggressively. Given the long time horizon of a newborn, these funds should be invested aggressively. This means they should mostly be invested in the stock market, which will likely outpace inflation and many other investments. For example, if you have $200 a month for 22 years from when your child is born until they get married, and the investments grow at 8% annually, you'll have approximately $138,000 to put towards the wedding. That's not a bad start, even with factoring in inflation. Number four is to set up separate accounts for each child. Well, the money should be held in the parent's name. It is advisable to segment the funds for each child. You don't want to be in a situation where the oldest child or children use up all the funds and there's nothing left for the younger children. In many financial institutions, you can put a nickname on the account, which will be helpful from an administrative perspective. For example, as soon as little Shani is born, you could set up an account and give it the nickname Shani's Wedding. When Shira is born, you set up another account with the nickname Shira's Wedding. Becky, Lily, and Mary will similarly have their own accounts. This will keep the wedding money for each child separate. Again, I don't think that paying for a lavish wedding should be a top priority for most from families. It's not necessary, prudent, or sensible. There are a myriad of better places to allocate your funds. This includes helping the young couple get established in their new life together, spending money on education, getting started in business, or for a down payment on a house are all far more practical choices that will produce a high return on these dollars. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me. Perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I like to end with a timely and actionable idea that listeners can implement to their own financial lives. And today's timely idea is going to continue on the theme I spoke about a couple weeks ago, which is for folks who want to have an impact with their money. Another way to do that is by investing in regions of the world that promote democracy and Western values. Many investors that I work with have specifically wanted to support Israel because it is the only democracy in the Middle East that promotes equal rights for women and members of the LGBTQ community. For those who don't know the region, Israel is surrounded by countries who would want to murder someone for being gay if given the opportunity. This bastion of democracy is a very dangerous part of the world, is understandably why many investors have expressed interest in investing in Israel, their companies, and also try to buy their products. I have helped clients do this by investing in Israel-based stocks, Israel-based ETFs, and individual Israeli bonds. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the money prudently, and ignore all the noise. See you next time on Jonathan on Money.